Have you ever lost money in stock market? If yes, watch this video till the end and you will see why did that happen. If not, still watch this can save you so much money in future. Let's understand with help of Sarah. Sarah did everything her financial advisor told her to do. Index fund, low fees, long game. Then the market dropped 11%. She sold everything. That decision cost her $40,000. She never knew why. Sarah wasn't reckless. She read the articles, watched the videos, did the homework. She opened a low-cost index fund, the thing every expert recommends. For 6 months, beautiful, steady, encouraging. Then April came. Every headline screamed disaster. Her phone buzzed every hour. And something inside her, something she couldn't name, started pulling. She sold. Here's what nobody told Sarah. She wasn't stupid. She wasn't weak. She was doing exactly what her brain was built to do. That's the problem. 50,000 years ago, you hear something in the bushes. 2 choices. The ones who ran survived. The ones who stayed curious didn't leave many descendants. Your brain remembers this. Every red number in your investment app, your amygdala reads it as a predator, not a dip, a threat. In 1979, Daniel Kahneman and Amos Tversky proved something that changed behavioral science forever. They called it loss aversion. Losing $100 feels twice as bad as gaining $100 feels good. Not slightly worse. Twice. You earn $500. You feel good. You lose $500. You feel like it's over. The numbers are identical. The emotion is not. Your caveman brain cannot tell the difference between a market correction and a bear attack. This is what we call the bear. Your portfolio drops. Red numbers appear. The amygdala fires. Cortisol floods your body. Your prefrontal cortex, the rational, planning brain, goes offline. You are no longer thinking about 10-year returns. You are thinking about survival. The bear looks real. It feels real. But the bear is just a dip. Every market crash in history, every single one, has recovered. 2008, the worst financial crisis in a generation, recovered. March 2020, a global pandemic. Markets lost 34% in 33 days. Recovered in 6 months. The bear always leaves. But your caveman brain doesn't know that. It just runs. And while it runs, it sells. JP Morgan studied what happens when investors panic sell and miss the market's best recovery days. Miss just 10 days, the 10 best trading days in a decade. And your annual return drops from 9.5% to 5.3%. Sarah A., who held, has $124,000. Sarah B., who panicked, has $84,000. Emphasis, $40,000. Not stolen. Not lost to fees. Lost to fear. DALBAR, one of the most respected investment research firms in the world, confirms this at scale. In 2024, the S&P 500 returned 25%. The average investor, 16.5%. An 8.5% gap in a single year. Not from picking bad stocks, from running from a bear that was never real. The bear took $40,000 from Sarah, not the market, her brain. Here's what nobody tells you. Loss aversion isn't a character flaw. It's ancient software running on the wrong operating system. You can't delete it, but you can install 3 patches. When the market drops, Sarah's portfolio isn't losing value. It's going on sale. The same fund she wanted last month, now cheaper. Reframing doesn't silence the caveman, but it redirects him. Gains feel good. Sales feel good too. Same number, completely different brain response. Before selling anything during a dip, Sarah waits 72 hours. The amygdala calms down within 24 to 48 hours. The rational brain comes back online. Most of the time, she doesn't sell. Because she's no longer running from a bear. She's reading a chart. Sarah automated her investing. Same amount, every month, market up or down. Then she stopped checking. The less you look, the less the bear appears. Research is consistent on this. The investors who check their portfolios least outperform those who check daily. Because they never see the bear. The people who ignore the bear build the most wealth. Sarah never panic sold again. Not in the corrections that followed. Not when the headlines screamed. Not when Mark did. Because Sarah understood something most investors never learn. The market isn't your enemy. Your caveman brain is. And once you know that, you can outsmart it. Quick question before you go. Have you ever sold during a dip and watched the market recover without you? Drop it in the comments. I read every single one. And if you've ever noticed that no matter how much you earn, the savings never seem to catch up. The next video explains exactly why. See you there.